Bitcoin is sitting right at the edge of $80,000 again. Not near it, not approaching it. It already touched above $80,000 this week, and then it slid back into the high 70,000s. Most people watching this chart think they understand what's happening. They think Bitcoin got excited. They think traders got greedy. They think this is just another crypto mood swing. But what if that's not the real story at all? What if Bitcoin isn't reacting to Bitcoin news? What if it's reacting to something happening quietly in a completely different part of the financial system? Somewhere most retail investors never even look. Because right now, the United States Treasury is sitting on a cash balance that could approach $1 trillion. And there's growing chatter that a meaningful slice of that money could start moving. Not maybe, not someday, possibly soon. And here's the uncomfortable question I want you to sit with for the next 20 minutes. Is Bitcoin front-running a liquidity wave that hasn't even arrived yet? Comment below right now, before you even finish this video, with the number you think Bitcoin hits next, 70,000 or 100,000. I want to see where this audience stands before I show you the case for both. Quick disclaimer. This video is for educational and informational purposes only. Nothing here is financial advice. Markets are unpredictable, crypto is volatile, and you should always do your own research or speak with a licensed advisor before making any investment decision. By the end of this video, we're going to connect Treasury buybacks, this mysterious trillion-dollar account, bond yields, the US dollar, and Bitcoin's price action into one single coherent picture. Stay with me, because once you see how these pieces fit together, you won't look at a Bitcoin chart the same way again. Also, quick one before we dive in, how's the weather where you're watching this from? Drop your city in the comments. I read every single one, and honestly, it's fascinating seeing how many different corners of the world are watching the same trillion-dollar story unfold in real time. And if this is your first time here, this channel exists for exactly this kind of thing, connecting the dots between government policy, big money moves, and what actually happens to your portfolio. So if that sounds like your thing, now's a good moment to subscribe to the Wealth Continuum because we're just getting started. Let's slow down and look at the facts, because the headlines have gotten ahead of themselves. The Treasury recently confirmed it will roughly double the size of its long-duration bond buyback operations. Instead of capping those operations at around $2 billion each, the new size is expected to be at least $4 billion per operation, starting on the 9th of September. Now, on its own, $4 billion sounds almost irrelevant. The US bond market is measured in the tens of trillions. 4 billion barely registers as a rounding error. So why did markets react like it mattered? Because markets weren't reacting to the $4 billion. They were reacting to the message behind it. The Treasury was essentially telling the bond market, we see the stress building and we're willing to step in. And that stress was real. The 30-year Treasury yield had climbed to around 5.3% recently, a level that ripples through mortgages, corporate loans, and government financing costs all at once. Then came the bigger headline. Reports suggested the Treasury could tap into its general account, potentially close to $1 trillion, to expand its bond buying operations even further. And that single idea is what pulled Bitcoin straight into this story. Hit like right now if you had no idea the Treasury's cash account could even move markets like this. Most people don't. That's exactly why this story is flying under the radar. Here's where I need you to pause and really think with me. When you hear $1 trillion, your brain probably jumps straight to some image of the government printing cash and wiring it into Bitcoin wallets. That is not what's happening. Not even close. The Treasury General Account is essentially the government's checking account held at the Federal Reserve. It's where tax revenue sits before it gets spent, and where borrowed money sits before it gets deployed. Earlier this year, official projections suggested this account could swell toward roughly $1 trillion. So why does anybody outside of Washington care about the balance in a government checking account? Because when that account gets drawn down, when Treasury actually spends from it, the mechanics can shift bank reserves and overall liquidity across the financial system. And liquidity, historically, is rocket fuel for risk assets, stocks, credit markets, and yes, Bitcoin. But here's the twist that most coverage completely misses. The money doesn't need to flow directly into Bitcoin for Bitcoin to feel it. Ask yourself this. If $1 trillion started moving through bonds, then equities, then credit markets, do you think crypto would be the last stop, or would it get there faster than anyone expects? Type your honest guess in the comments. I want to see if this audience thinks like Wall Street or thinks like Main Street. Picture the financial system as a chain of connected reservoirs, each one feeding into the next. The Treasury is the first reservoir. The banking system is the second. Bond markets are the third. Stocks are the fourth. And crypto sits at the very end of that chain. Money doesn't leap directly from a government account into your Bitcoin wallet. It moves in stages. Let's walk through it slowly, because this is the part that actually explains everything. Say the Treasury uses part of its cash balance to buy longer-dated bonds. That extra demand pushes bond prices higher. When bond prices rise, yields tend to fall. Once yields fall, something subtle happens across the entire investing world. The safe return on government debt becomes less attractive. Investors who are happy parking money in bonds start asking themselves a different question. Where else can I get a better return? And that question sends money moving down the risk curve, out of treasuries, into corporate bonds, then into stocks, then into growth assets, and eventually, for a certain type of investor, into Bitcoin. That's the transmission mechanism. That's the invisible pipeline connecting a government bank account to your crypto portfolio. This is exactly why the $1 trillion figure matters far more as a liquidity signal than as a literal number tied to Bitcoin. But here's what really should be keeping you glued to this video. If markets already believe this liquidity is coming, do they really wait around for it to show up before they react? Markets rarely wait for confirmation. They price in expectations long before those expectations become reality. If enough investors believe something is coming in 3 months, the market often doesn't wait 3 months. It starts moving today. And Bitcoin might be the most sensitive asset in the world to this kind of expectation game. It trades every single hour of every single day. There's no closing bell, no waiting for Monday morning. It can react to a rumor at 3 in the morning on a Sunday. That's exactly why Bitcoin can move well before traditional markets fully catch up. And look at what's actually happened. Bitcoin surged sharply off its recent lows, broke above $80,000 for the first time in more than 3 months, and then eased back into the high 70,000s as this video is being made on Wednesday, the 26th of August, 2026. At the very same time, chatter about a Treasury liquidity injection has intensified. So here's the real question, and I want you to actually think about this instead of just scrolling past it. Is Bitcoin correctly predicting a liquidity wave headed our way? Or is the market simply getting ahead of itself, pricing in a story that might never fully arrive? Those two answers lead to completely different outcomes for your portfolio. Stay with me, because the next part is crucial. Because there's a dangerous myth spreading online right now, and if you believe it, you could badly misread this entire setup. Here's what they're not telling you clearly enough. All over social media, you'll see people confidently declaring, quantitative easing is back. They're treating Treasury buybacks like they're identical to the Federal Reserve printing new money. They are not the same thing, not even close. The Treasury and the Federal Reserve are two entirely separate institutions with two entirely separate jobs. The Treasury manages how the government finances itself. The Federal Reserve manages monetary policy and the money supply. When the Treasury buys back its own previously issued debt, it's primarily trying to improve liquidity in longer-dated bonds and smooth out the maturity structure of what it owes. The Treasury itself describes these operations as liquidity support, not stimulus. So if it's not quantitative easing, why should Bitcoin investors care at all? Because markets respond to actual financial conditions, not to whatever label economists slap on a policy. If these operations ease pressure on long-term bonds and yields drift lower, and the dollar softens even slightly, and overall liquidity becomes a bit easier to access, risk assets can respond anyway, with or without the official label of quantitative easing attached to it. Bitcoin doesn't check the paperwork. Bitcoin responds to the environment it's trading in. Comment understood below if that distinction just clicked for you, because this is honestly one of the most misunderstood parts of the entire story right now. Let's back up and ask the obvious question. Why is the Treasury intervening in the first place? The United States now carries more than $40 trillion in national debt, and when long-term borrowing costs rise, the government has to pay significantly more just to keep refinancing what it already owes. This creates a loop that's genuinely difficult to escape. Bigger deficits require more borrowing. More borrowing means more bonds get issued. More issuance can put upward pressure on yields. Higher yields raise the government's own interest costs, and higher interest costs make the deficit even harder to control. Round and round it goes. The Treasury's current intervention is essentially an attempt to calm down the long end of that bond market before the loop spirals further. But, and this is important, not everyone thinks it's working the way it's supposed to. Some financial reporting has pointed out that these buybacks may only be offering temporary relief, while the deeper concerns about inflation and government debt remain completely unresolved underneath the surface. In other words, Treasury can influence liquidity in the short run. It cannot magically erase $40 trillion of debt with a single policy tweak. This is where it gets really concerning, because the story isn't as clean as problem solved. Here's something most crypto investors never stop to consider. Bitcoin isn't living on an island, disconnected from the bond market. One of the biggest hidden variables driving Bitcoin's price might actually be the cost of money across the entire economy. When Treasury yields climb aggressively, investors suddenly have access to attractive, relatively safe returns just by holding government debt. That makes speculative assets, including Bitcoin, look less appealing by comparison. Why take on massive risk when a boring bond is paying you well? But flip that scenario. If yields start falling, the entire equation shifts. Suddenly, that safe return isn't so attractive anymore, and investors become more willing to climb back out onto the risk curve. That's precisely why this Treasury intervention matters so much for crypto. Not because Treasury is buying Bitcoin directly, it obviously isn't, but because Treasury may be quietly changing the relative appeal of every asset sitting above it in the risk spectrum. And Bitcoin sits near the very top of that risk spectrum, which means when liquidity expectations shift, Bitcoin can react far more dramatically than almost anything else out there. But there's still one more piece of this puzzle we haven't touched yet. And honestly, it might be the most important one, the dollar. Let's run through two different scenarios together because this is where the story really opens up. Scenario 1. The Treasury successfully calms long-term yields. The bond market settles down. Risk appetite slowly improves. The dollar stays roughly stable. That alone would likely be a mild positive for Bitcoin. Scenario 2 is far more interesting and honestly far more dramatic. The Treasury deploys a large chunk of its cash balance. Markets interpret this as another form of financial support, similar in spirit to past liquidity interventions. Bond yields drop. The dollar weakens alongside them. Investors start looking for alternative places to store value because a weaker dollar means your cash buys less over time. And in that scenario, Bitcoin could get hit from two directions simultaneously. Rising risk appetite, plus growing concern about the dollar's purchasing power. That combination is genuinely powerful. It's part of the reason Bitcoin so often gets mentioned in the same breath as gold whenever fiscal stress starts building. But, and I really want you to hear this part, don't assume this automatically means a straight lineup for Bitcoin. There's a serious risk sitting underneath this entire thesis that almost nobody is talking about. Subscribe if you want to actually understand these hidden macro connections before they hit the mainstream headlines, because this is exactly the kind of story the wealth continuum was built to break down. Here's the uncomfortable question nobody wants to ask out loud. What happens if this Treasury intervention simply doesn't work? If bond investors start believing the government is trying to artificially suppress yields instead of genuinely fixing the underlying deficit problem, they could demand an even larger risk premium to keep lending money. And that flips the entire script. Yields rise instead of falling. The dollar becomes unpredictable and volatile. Financial conditions tighten instead of loosening. Risk assets, including Bitcoin, could get dragged down instead of lifted up. This is exactly why the Treasury story is not automatically bullish, no matter how many headlines frame it that way. It's a genuine policy experiment, and experiments carry consequences. Even prominent voices in finance have pushed back hard on this. Some well-known investors have argued that these Treasury actions look more like market manipulation than a genuine fix for the fiscal problem. Major trading firms have gone even further, warning about what they're calling financial repression, essentially policy designed to keep yields artificially low at the expense of savers and bondholders. So now we have two completely opposing narratives, fighting for control of the story. One says, this is a liquidity rescue and risk assets should benefit. The other says, this is fiscal desperation, and it could eventually backfire in a big way. And depending on which narrative wins out over the coming months, Bitcoin could react in two completely opposite directions. Which one do you believe? Rescue or desperation? Comment your answer below, and tell me why. I genuinely want to read your reasoning, not just your vote. Let's bring this back to Bitcoin directly, because everything we've covered so far leads to this exact price level. $80,000 isn't just another round number sitting on a chart. It's become a genuine psychological line in the sand. Bitcoin has already tested above it this week. But testing a level and actually holding above it are two very different things. If Bitcoin can establish itself above that zone, while Treasury liquidity expectations stay elevated, traders will likely read that as confirmation that the bigger thesis is playing out correctly. But if Bitcoin keeps failing around $80,000, bouncing off it again and again without breaking through cleanly, the market could start whispering a very different message. Maybe this liquidity story is already fully priced in, and there's simply nothing left to push the rally forward. And that sets up a genuine battle between expectation and reality. Bitcoin can absolutely front-run a liquidity event. History has shown that repeatedly. But it cannot front-run that event forever. At some point, the underlying conditions have to actually validate the move, or the price gives it all back. This is where it gets really concerning if you're holding through this level without understanding what's actually driving it. So, practically speaking, what should you actually be tracking over the coming weeks? Let me give you three concrete signals. Signal number one is Treasury yields, specifically the 10-year and the 30-year. If long-term yields keep drifting lower as the Treasury expands its buyback operations, that's generally supportive for risk assets like Bitcoin. If yields suddenly reverse and spike higher instead, treat that as a genuine warning sign. Signal number 2 is the dollar. A weakening dollar paired with improving liquidity conditions would be a particularly interesting combination for Bitcoin. But a sudden sharp spike in the dollar could signal that markets are shifting into risk-off mode. Signal number 3 is the actual liquidity operations themselves, not just the headlines about them. Don't get distracted by dramatic phrases like $1 trillion is coming. Watch what the Treasury actually does, month by month. There's an enormous gap between simply holding $1 trillion in an account and actually deploying a meaningful portion of it into the market. That gap between having the money and actually spending it might be the single most important detail determining whether this Bitcoin rally has real legs or whether it quietly runs out of steam. You need to understand this before I show you what's next, because this next part ties every single piece together. Here's the truth this entire video has really been building toward. This was never really just a story about Bitcoin. It's a story about the collision of 3 enormous forces: debt, liquidity, and trust in the dollar-based financial system. The United States government now carries more than $40 trillion of public debt. Long-term borrowing costs matter enormously against a number that large. The Treasury is now actively working to support liquidity and longer-dated bonds. And at the same time, the Federal Reserve has been managing its own reserve conditions, with its balance sheet already expanding during 2026 through Treasury bill purchases and related operations. Investors are watching every single one of these moving pieces through the lens of inflation, fiscal deficits, and long-term confidence in the dollar itself. Bitcoin just happens to be sitting directly at the intersection of all of these forces at once. That's exactly why $80,000 matters right now. Not because that specific number carries some kind of magic, but because it could become the exact price level where the market finally decides something important. Is this simply a crypto bounce that fades like so many before it? Or is something genuinely bigger happening underneath the surface of the entire financial system? Here's the part I think deserves your full attention more than anything else in this video. The biggest catalyst for Bitcoin might not come from inside the crypto world at all. It could come from Washington. It could come from the Treasury market. It could come from a sudden shift in the dollar, or it could come from an unexpected change in liquidity conditions that nobody saw coming. That's exactly why the $1 trillion figure carries so much psychological weight right now. But remember what we established earlier? Because it's worth repeating one more time. $1 trillion sitting inside a Treasury account is not the same thing as $1 trillion actually entering Bitcoin. The real question sitting underneath all of this is simple to state, but genuinely hard to answer. How much of that liquidity actually gets released, through what specific mechanism, and what does the market ultimately choose to do with it once it arrives? If the Treasury successfully lowers long-term yields without triggering a fresh inflation scare, risk assets across the board could genuinely benefit. If the dollar weakens at the same time, Bitcoin could become even more attractive to a wider range of investors. But if bond investors reject this intervention outright and yields surge right back up, the entire bullish thesis could unravel far faster than most people expect. And that tug of war is exactly what's happening underneath the surface of the Bitcoin chart you're looking at right now. So let's step back and pull every thread together. Bitcoin approaching $80,000 might look, on the surface, like a simple technical story about crypto sentiment. It isn't, not even close. Underneath that price sits a much bigger, far more consequential question. Is the world's largest economy quietly entering another phase of liquidity support, whether or not anyone officially calls it that? The Treasury is already buying bonds. The size of those buybacks is increasing, starting on the 9th of September. The possibility of tapping a massive cash balance close to $1 trillion is actively being discussed in financial media. Long-term yields remain under real pressure, and Bitcoin appears to be responding before this entire story has even finished playing out. But here's your warning, and I want you to actually remember this one. Don't blindly assume that $1 trillion automatically equals Bitcoin going up. Markets simply do not work in such a straight line. The real signal is going to come from watching the combination of all 4 pieces together: Treasury liquidity, bond yields, dollar strength, and Bitcoin's actual ability to hold above $80,000. If all 4 of those pieces start moving in the same direction at once, this story could become far bigger than anyone currently expects. And if they don't line up, Bitcoin's current rally could prove a lot more fragile than the headlines are currently suggesting. So the real question isn't simply, will Bitcoin hit $80,000? We already know it briefly did. The much bigger question is this: what happens to Bitcoin if Washington actually turns on the liquidity in a serious way? Because if that happens, $80,000 might end up being remembered as the beginning of the move, not the destination. Before you go, I want to hear from you directly. What are you doing while watching this video right now? Are you commuting, working out, or just relaxing with your phone? Drop it in the comments. Genuinely curious where this audience is tuning in from today. And one more honest question before you leave. After everything we just walked through, do you believe Bitcoin is being driven by real liquidity fundamentals, or is this simply speculation running ahead of itself? There's no wrong answer here. I just want to see how this community is thinking about it. If this video helped connect some dots for you, hit like so more people see this breakdown. And if you know someone who's been asking, why is Bitcoin moving right now, share this with them. This is exactly the kind of context they're missing. If you want more breakdowns connecting Bitcoin, the Treasury, the Federal Reserve, and global liquidity into one clear picture, subscribe to the Wealth Continuum. Because based on everything we just covered, the next major move in Bitcoin may end up being decided far away from the crypto market entirely, inside a bond market and a government checking account that most investors never think to watch. See you in the next one.